Thank you for joining us at xm.com for today's market comment by Harlan Bospisuros. I'm Maria Pachurdes. The dollar continued gaining ground against most of its major peers on Thursday, breaking back above the 151 level against the yen and adding to the risks of intervention, even as a former BOJ official said he thinks the bank should end its negative interest rate policy as soon as in January, and even after Governor Ueda said yesterday that they don't need to wait until inflation-adjusted wage growth turns positive before ending their ultra-loose policy. Dollar traders may have decided to stick to their long positions initiated after several Fed officials left the door open to higher interest rates, as Chair Powell did not comment on monetary policy in the speech he delivered yesterday. Powell is scheduled to speak today as well at a panel discussion on monetary challenges in the global economy. There may be more chances to make a reference to interest rates today, and if so, it will be interesting to see how the dollar and other markets that are sensitive to the Fed's actions and plans will respond. The 10-year Treasury yield continued to slide yesterday despite the dollar continuing to perform well. On top of that, the market's implied rate path derived by Fed funds futures continues to suggest a slim probability of another hike and around 90 basis points worth of rate cuts by the end of next year. On Wall Street, although the Dow Jones slid somewhat, the S&P 500 and the rate-sensitive NASDAQ slightly extended their gains, perhaps aided by the further retreat in long-dated yields. However, during the Asian session today, sentiment deteriorated as the spotlight turned back to China's troubled property sector. On Wednesday, a Reuters report said that Ping An Insurance will take over Country Garden Holdings and assume its debts, but a spokesperson for the insurance firm denied the report today. Hong Kong's Hang Seng reversed earlier gains and closed in the red, while the Hang Seng Mainland Properties Index fell almost 3%. Oil prices extended their tumble yesterday as concerns about weak demand from China have been weighing on them lately, with the market clearly less concerned now about the Middle East conflict. Gold also edged south yesterday as the Middle East risk premium appears to be fading. On top of that, considering the opposite directions in the dollar and yields lately, precious metal seems to be driven more by the recovery in the greenback. Therefore, should the dollar stay strong for a while longer, gold could stay under selling pressure. Thanks for watching today's market comment here at xm.com.